So let me start by saying thank you to everyone for joining this Mayor Capital quarterly Q&A. It's the third such video conference that we've done this year. The first was in the middle of March, in the middle of the volatility caused by the pandemic at the beginning of the circumstances in which we all find ourselves in. We wanted at that time to allow our clients and partners to get some insight into how we were dealing with the volatility, the opportunities it presented, and the risks that we were trying to mitigate against. The second, in the middle of the year, was for the first time fully online. We'd much prefer it to be in person, but our annual partners meeting this year was fully online, and this is the third of those. And all of these events are really designed to help fulfill our promise in our partnership principles of straight talk, the commitment to communicate regularly with our clients and never overpromise and under deliver. That's the thing that we want to avoid. Now, the communication, though, is a two-way street, and for the first two of the events that we hosted this year, Mayor was in some way on broadcast mode, but communication is also about listening, and this is what the Q&A is designed for, is to allow our clients and partners to ask questions of us. And this has a couple of benefits, at least. The first is to allow an additional forum after the publication of our quarterly investor letter to allow you to respond to that, to ask any questions that you may have as a result of that. And you can do that by using the Q&A function that, and typing your question, and I'll be able to hand it over to Aziz and Aubrey, who are also on the line. You'll see them in a moment. The other benefit, of course, is for us, where we're able to hear your about things in a slightly different way, gain a different perspective, and so that is the purpose of the call. You will see that we've allocated 30 minutes to that. That's very much a limit and not a target, and so we the content of this call is largely dependent on you asking some questions. Now, we've got two questions already in, so that makes for a good start. The first of those is something I've also actually been fielding during some client calls over the last week, and that's namely on the US presidential election next week. Now, elections are always sometimes a little bit tricky to forecast. You know, if you look at the UK parliamentary elections, for instance, sometimes the scale of the victory is also just as important as the the winning party itself. And you look at other elections around the world with coalition governments and what have you, the potential distribution of outcomes is too large to model. But I guess in the US presidential, the Congress race notwithstanding, that election is much more of a binary event. So even though the outcomes may not be 50-50, there are just two options of who will become president. So the question that I'll ask Aziz and Aubrey is how is it possible to model that? How is it possible to forecast that? Is it possible? And as a result, how do we view the potential events over the next week and perhaps beyond, given the race? So I'm just about to hand over to Aziz. If you just bear with me for a second, you should be able to see him on the screen now. You're currently muted, Aziz, so if you could take yourself off mute, which I think you have done.
So elections are tough, like Mark said. I don't know that with everything that has to do with decision making and investing, I think three questions are relevant. One is whether you can guess the outcome. B, whether your guess is going to be differentiated from what's already the median guess, and that's what's priced into the market. And the third one is whether you can position your portfolio in a way to actually capitalize on that guess or prediction. And I've always taken the view that number one is possible. Basically, can you predict something? Sometimes you can. I think in politics, it's often not the case, but in general, as a matter of principle, I think in some cases you can. The second one is the tough one. Can you actually have a view that's differentiated from the median view? And I find that the easier the first one is, the prediction, the harder the second one is. And the third one is positioning your portfolio in a way to benefit from such a prediction. And I think that's probably hardest when it comes to something like a national election of the president or Congress or Parliament, whatever it is. It's not always clear because you don't know what it means that someone or a party is going to be in power and for so long. And so I've always taken the position that if you can't do something with a prediction, why bother, effectively? Now, when it comes to this particular election of the US presidency, and I don't want to spend a lot of time on the politics of what's happening. I don't think it's, neither am I an expert or this the venue for it. I do take the position that this election matters more than others. And the reason I think that's the case really comes down to the current US administration's attitude towards global norms when it comes to economic rules of play and also political rules of play. And often there are things that they do that a sensible person would still agree with, but the method, I think, is the issue. And as someone who plans on investing for their next few decades, I think it's in my interest as an investor to have reasonable rules of play economically and politically, and have a system of governance globally that everyone agrees on, everyone follows. And anyone who wants to break these rules or destroy the system, even if there's a short-term benefit to that person doing it, I think is detrimental to effectively long-term rules of play and outcomes for investors who take a long-term view, at least one that is multiple decades and not a few years. And so that's why I think it's for the benefit of the world and the world's economy, and within that like long-term view, that we have someone more sensible and more respecting of norms as US president. Regardless, to me, it doesn't really matter what happens in the next 4 years. I'm more concerned about kind of the multi-decade view and the things being more fundamental. I don't know, Aubrey, do you have any comments?
Hold on.
Let's, you're muted, Aubrey, you need to unmute yourself.
Can you hear me now?
Yes.
Yes, we can.
Yeah, I mean, I don't have a huge amount to add to that. I mean, the only caveat I would add is that I think the market may not be pricing in what happens if there is a contested election and how bitterly and how violently, and I do mean how violently, that election is contested. But as Rothschild said, you buy when there's blood on the streets, even if that blood is your own. If there is disturbance caused, it will be an opportunity for investors. But we just hope that there aren't. Well, I just hope it goes smoothly.
Okay, right. Thanks for that. We've got We've got another question here about, well, this is more Maya focused, I guess, which is a lot of our material, some of the way in which we've self-identify, particularly Aziz, if I may say so, is that of a value investor. And then when you look at the fact sheets, we include the Morningstar style box on that. And the portfolio seems to spend more time in the blend category than it does in the value category. And indeed, the Morningstar peer group in which we categorise is indeed the blend category. So I was just wondering if Aziz could shed some light on that seeming discrepancy.
Well, I mean, to quote Buffett, I think he talked about this in the past, and he said growth and value are joined at the hip. And I've always viewed value investing as really coming down to the idea that you want to buy something for less than it's worth, having a margin of safety below what something is worth. And I think traditionally, especially in academia, but also with a lot of the index providers and the fund databases, it's been viewed as this binary thing in between two camps. And the example that I always kind of use is I view value investing as the difference between shopping on the high street or / main street or the mall and shopping at the outlet mall. And so if you want to buy an item of clothing, your options are either to go to say, for example, no bias there, to a Nordstrom in your local mall, have amazing service, enjoy the experience very much, and pay full price for that item. And the other option is to get into your car and drive outside town, usually in a slightly, if not very inconvenient location, park and walk a long distance, walk into an outlet shop, and where you will get pretty much no service. There are barely enough staff in the shop to check you out when you're ready to pay. But you can buy something for half price, sometimes even more. You have that same option between the two, whether you're buying a luxury item or you're buying a cheap item. There you can pay full price or you can pay the discounted price. I view value investing as choosing to shop at the outlet mall, buy at the discounted price. Now at the outlet mall, you'll have people who buy luxury items and people who buy cheap items. I view all of them as value investors. It's just that they'll have preferences of where, in terms of the quality or growth spectrum, they want to shop. So I don't view it, I view them as different axes and not a spectrum between value and growth, I guess. And then I think when you look at something like the blend category in Morningstar, it really is just that space in between an extreme, and they're just viewing it through either something that has a high multiple and high growth, and another one that has a low multiple and low growth. And I think just looking at judging value based on a multiple is just, for lack of a better word, lazy. There's a lot that goes into valuation. You can have a low multiple stock that's overpriced and a high multiple stock that's underpriced. Aubrey, I know we were discussing this not that long ago.
Aubrey, I just wondered if I could supplement that question to you by saying, when you're generating ideas, when you're trying to come up with something to include in the portfolio, is that sort of style bias something that you give much thought to at all, or is it just an outcome of the types of ideas that you try to generate, or something else?
Yeah, so I guess we don't start with asking what what the value is. We start with asking, what is the business? How good is this a good quality business? And then the final thing is, what price do we want to, what is it worth to us, and what price are we willing to pay for it? And that's the value bit of it, that we say, look, it's worth this, we're going to pay this, we're going to pay something lower. If it's a really high growth company, we will make very conservative assumptions, but we will buy companies that grow, and we will pay premiums for, we'll pay more for a company that's growing than a company that's declining. I mean, that's just obvious. I don't know. I just think this whole thing is, the whole value growth debate. It's like the Beatles versus the Rolling Stones, Blur versus Oasis. It's all just music. We're all fundamental investors. We have a particular preference for paying less and for making less speculative assumptions, and perhaps being more conservative. But we're all fundamentalists. We're all fundamental investors. And it's the fundamentals that are important. And then the last step is, what price will we pay for it? Because hey, if it's too expensive now, I can guarantee you within the next 5-10 years, whatever it is I'm looking at will come, will come in Aziz's discount rack, and we'll be able to buy it. Although it has been a long time for some businesses.
Okay, I'm gonna switch back to Aziz with another question, and this is any insights on the active/passive trends gleaned from the volatility experienced in 2020? Specifically, does it present opportunities going forward for skilled investor to outperform? And I guess here, Aziz, this plays into something we've been talking about all year, which is the importance of active share for an active manager, and something that's been an issue in much bigger houses, I think, for much bigger asset management houses for some time. The issue of how different is your portfolio from your reference benchmark?
Yeah, I think a lot of people leading to this year and for the past few years have been talking about the risk to the market from passive investing. And the idea is that basically this explosion in passive investing is going to cause fundamental issues that are going to destabilize the market, and we'll show them basically. And I've always taken the view, and I still do, that it's not clear to me that the argument is points in one direction versus the other, and perhaps it's the other way around when it comes to an issue of market instability, with one exception. That exception is in the case of assets where the liquidity of, say, an ETF is much higher than the liquidity of the underlying assets. And I mean, we've seen this for many years, even before passive investing, with listed real estate funds in the UK, for example. But more recently, we've seen it in bond ETFs that are indexed against a certain benchmark and other types of assets where the underlying is less liquid than the fund. And there are mechanisms, to be fair, in these vehicles to allow for a situation where if these things become illiquid, then you either suspend redemptions, or in the case of things where it's closed end, you end up with a situation where you either redeem in kind, or there are ways where that doesn't necessarily impact the market. That being said, in cases where, and this is not the case this year, but in cases where we might have a prolonged situation where there's a problem in the market and liquidity disappears for a long period of time, one's got to wonder what happens. At some point, these funds are going to have to dump the assets that they own at some price as a forced seller. We haven't seen it this year. I think mainly because the time where the market was really panicking was relatively short. But either way, I think that in any case, I think that impacts a small percentage of the market. I don't think it impacts all of the passive universe. The other argument that's been used for a very long time is without someone, i.e. the active manager, setting the price, who's going to be finding the fair price for these tradable assets? And to be honest, I don't think we need this many active managers to set the fair price for most assets. I think this idea that the market is going to stop finding a price if you go from X thousands to a few thousand investors, professional investors, that it doesn't work. I think it still works. I mean, the question isn't whether 20% or 40% passive is going to disrupt the market. I'm not worried that either of them. Theoretically, yes, if you have a situation where everyone is passive investing and there's no price discovery, I think the line there is much, much higher on most assets in most markets. There are exceptions, but I think that's generally the rule. I think more fundamentally, the people who are making these, often the people who are making these assumptions are people in our industry where it's out of self-interest that they don't want you to be a passive investor and they want you to be an active investor. And I think the industry, and I wrote about this in my recent letter, I think the industry has just generally been lazy for a couple of decades. And they've been selling these low active share portfolios to investors to enrich themselves while investors are paying active fees to get quasi-passive portfolios. And it makes no sense whatsoever that would continue, and it hasn't been continuing. For the past decade, if you see where money has been leaving active funds, it's been predominantly, there's a very clear correlation between low active share and money leaving funds in the past decade, and I think that's going to continue. I think investors have wised up to the situation, and they realize that I'm not going to pay you active fees to give me a portfolio that's 80% passive with a little bit of active picks on top. That makes no sense to me, and I think we'll move more to a situation where active managers really have to be active. They need to take career risk that they're going to be wrong, because that's the only way they add value to investors.
Aubrey, I'll bring you in for a second here about what active means in terms of engagement for the ultimate shareholders, you know, the clients, because I think we saw this earlier in the year, or perhaps last year with Merlin, that if you're a passive investor, that also means passive, being passive from an activist point of view, if that means, if that makes sense. Is that something that you draw a distinction between?
Well, I think if you are an active shareholder, you ought to raise your voice when you think you ought to say something. I mean, we've just been talking about the election in America. You know, we have a democratic right with companies too to select our managers, to select, you know, to have influence over certain decisions that go on within them. And just as I believe it is, you know, your duty as a citizen to vote in your you know, country's elections, it is also your duty as a shareholder, you know, or as a steward of someone else's capital, to vote accordingly. You know, Merlin, you know, sadly, that's, you know, maybe not the best example, given that the board were able to ride roughshod over everything we wanted. But you know, there are other instances, and certainly, you know, we've discussed with ESG issues that, you know, if a company is engaging in practice we don't like, we ought to say, you know, hang on, you know, we want to be heard on this.
Okay, we've got one more question coming in the in the absence of any more questions coming in, I guess this will be the last one, and it's about the investment trend of the moment, namely ESG. And so the Maya Fund has an ESG influence in its process, but outside of the firm, what do you do to meet ESG targets? So I guess this is, a lot of people are suddenly claiming to be ESG. I think if you read our quarterly letter, you would have seen Aziz's quote from his first ever investment letter in the early 2000s. I'm sure he can give us the exact date, about how the investment process would aim to look for companies that have best practice in what is now known as ESG. So that's within the fund, but that's to some extent talking the talk. How does Maya walk the walk in terms of overall business practices? We want the businesses we invest in to be best in class in terms of ESG, and I guess the question is, how does Maya do that internally as well?
I think, yeah. So that quote was from a letter I wrote to my first two investors in 2001, and I've just always taken the view, and now it's hip and everything, but I've always taken the view personally that I didn't want to invest in something that I did not agree with ethically. To me, if you think of investing as owning businesses and being partners with the management team and the other investors in a company, to me it flows naturally that you want to be doing business with people that not only just trust, but also think you agree with in terms of ethical values. It makes no sense to say, I want to be partners with someone, and if they make me enough money, it's okay that they're crooks. So that's always been my position as an investor. And before I knew what, I don't even know if the term ESG existed at the time, to be honest. But I've always used the term ethical. And it made perfect sense to me that we would do that. And also made perfect sense to me that we probably are not going to give up much in terms of returns by doing that. Because I also think that it reduces risk to invest with ethical people and in ethical businesses. I think the difference between long-term risk and short-term risk is where the ethical angle comes in. If you have a long-term horizon, it's in your interest to look at things like your impact on society, on the environment, on the importance of governance becomes higher, how you treat your different stakeholders, whether it's your employees or your customers or suppliers. I think the two, those things come together if you have a long enough investment horizon, and I always have. And so that made perfect sense to me as an investor. Now, we're now in a position where Mayad over the years has moved from me sitting behind a desk working by myself to building an organization, which means that as a leader of that organization, I also have to lead by example in the same way we expect the companies we invest in to behave. We, as a firm and as an organization, have to behave, and I think otherwise you're a hypocrite if you're not doing that. And so we believe that in everything that we do internally, we have to find ways to do things that are better / less harmful to the environment. We have to have better governance. We have to treat all our stakeholders well. We need to find ways to add value to our communities. And it's not just about making money quickly. And I think if you want to maximize your returns over the next 10, 20, 30, 40, 50, 100 years, and that's what we want to do at Mayab, then you have to care about these things because they are fundamental to how your stakeholders treat you. And you're going to need stakeholders who invest with you on an ongoing basis and believe in you in order to succeed over time. So yeah, we mentioned some of the things that we're doing on the environment. We are in the process now of working with a couple of firms on things like our carbon footprint and how we can reduce that. We've been using renewable energy at the office for a while now. We've been, whether our approach towards recycling and minimizing waste and all of that, it's not as big of an impact for us as opposed to, say, a consumer packaged goods company, but every bit counts, right? And so I think there are a lot of things that we can do as a firm to do that. And as individuals, as a firm is nothing but a collection of individuals. And it's not just what we do here, but what we do at our homes and what we do in our communities. And I think as we grow, our ability to have bigger impact on our stakeholders only grow with us, but also our responsibility to act in that way will grow. And as some of our investors know that 15 years ago, I co-founded with Akushay, which was a responsible coffee shop in Khobar in Saudi Arabia. And we led there with things like sustainable packaging, fair trade organic coffees and teas and chocolate. And I think at that point in time, a lot of the things that I now know and believe in developed through the experience of building or helping build that company with my co-founders, and seeing how even at a small scale, you can have an impact, not only through the direct impact that you have on, say, the environment, but also the message that you're sending to all your stakeholders. And kind of the compounding effect of that message going out throughout the community, and therefore the much bigger impact on the environment that way.
Okay, thank you. We've got one more question. I think we'll make this the final one. If you do have any more questions, please feel free to contact any one of us. We're always happy to field questions. One of the old truisms is never ask a question you don't know the answer to. I feel like I do know the answer to this, but I'll have to ask it anyway. Aziz, how do you feel about the other big trends these days, SPACs, which I think are special purpose acquisition companies? So Aziz, how do you feel about those?
So I don't know if any of you have been looking at this. I certainly have been following it closely, and I think it's a sign of the times. And if you haven't, look it up and read about it. But it's a sign of the times that you've had all these. They used to call them blank check companies, and now they came up with SPACs as the cool alternative. But basically, the idea is that investors give the sponsor of this vehicle a lot of money to do whatever they want without telling them beforehand what is it that they're going to do. And most of the use case for these have been for companies to do effectively an indirect initial public offering in a quick way that circumvents the rules and regulations in place for initial public offerings. And so the use case has not been good more recently, especially. And the reason I say I don't think it's good is I don't think, well, I think the rules are there for a reason. Everyone should be following them, even if you don't like them. But I think we have a situation where a lot of founders these days think that they're special and the rules don't apply to them. That being said, I do think that there are situations where SPAC make perfect sense. And that's the original use for things, or effectively the ideal use, and the use that I'd like to have, which is that you have access to permanent capital. And so in the hand of a good investor, a vehicle with permanent capital can give that investor or a manager tremendous advantage in investing. Because, I mean, we've always talked about this, and I've always believed that having a long-term investment horizon is a tremendous edge in markets. And if you can have that horizon and that ability to invest long-term be structurally built into the vehicle that you have, which is what having a permanent capital vehicle does, then I think that gives you a tremendous advantage in being able to look beyond the short term and making investment decisions. The perfect example of this is a Berkshire Hathaway, where Buffett doesn't have to worry about either raising money or dealing with redemptions. So I think the current movement towards SPAC will probably end in tears, sadly, because I think what starts as a good idea ends with being abused on Wall Street very often, and I think that's what's already happening right now. But I think at some point in the future, it'd be great to have a vehicle that has permanent capital. I think it'll allow us to invest for a very long time, and I think we are psychologically in a position to invest long term. I also think by picking investors who share our values and our investing values, we are better positioned to act as if we have permanent capital. But the reality is, if we had permanent capital, we definitely could be doing and acting in ways, whether it's in private markets or otherwise, where we having that vehicle gives us an advantage, I think. Aubrey, do you have anything to add here, or?
I mean, look, once upon a time, I used to work in the sort of slightly grottier end of the AIM market, and there were plenty of cash shells there. Actually, a lot owned by Lord Ashcroft. You know, they'd have sort of 5 million in them, and you know, they'd be touted by one of the sort of smaller brokers, and you'd have a management team who would just go out looking for opportunities to buy something. As investments, they were always actually as speculations, they were actually usually pretty good, because you buy it, you'd be able to buy it at a discount to cash, and usually when management bought something, made a reverse acquisition, the share price popped, but you're dealing with no liquidity, you couldn't make a living out of it. As Aziz says, the thing is, they are blank check vehicles, and look, if anyone wants to give me a blank check to go and buy a business, great. Although someone's already beaten me to Playboy, I think that's already done. But yeah, no, it's we'll look at them if anything interesting comes along, but with the likes of Playboy, no thank you, not really. Nikola, well, I'm sure you've all seen that it's an amazing truck that only works downhill. If this is the quality of the SPACs that we're getting at the moment, I think we'll probably pass.
Okay, well, thank you for that. We haven't had any more questions come in, so I think we'll leave it there. I want to extend my thanks to everyone for joining this afternoon, and to reiterate the fact that our door for questions is always open. So if anything occurs to you post this meeting, please feel free to get in contact. I think we'll leave it there. So thank you very much, and we look forward to the next edition of this, which we hope will be at the end of January. But you'll be able to see the invite to that at the time. So thank you very much, and from everyone, stay safe, stay healthy, and we'll see you soon. Goodbye.